Home prices in California are expected to decrease by 8.8% next year. This is according to a new report from the California Association of Realtors that was just announced today. So in today's video, I'm going to share their housing market forecast for next year from the California Association of Realtors, which has some pretty eye-opening trends that they're forecasting here. And before that, if you guys are looking for a real estate agent referral, whether you're looking to buy or sell a house, then check out that link below, which is homeandmoney.com/Jason. And with that said, let's begin today's video for the latest housing market forecast for California here. It says here, a market shift is underway as a mild recession and higher interest rates cut into housing demand. Existing single-family home sales, which of course exclude brand new home sales, are forecasted to be at 333,000 units in 2023, a decline by 7.2% from 2022. And check this out, because they are forecasting that the median sold price in California is going to decrease by 8.8% down to 758,000 in 2023. To me, this makes sense given the fact that housing affordability in California is almost at a 15-year low. More on that here in just a little bit. Also, this dip in home prices makes sense given the fact that the average 30-year fix is over 7% right now. And speaking of housing affordability here, they are expecting a drop to 18% next year after projected 19% in 2022. What this means is that only 18% of California's households can afford to buy a median price home in California here. So only 18% can afford to buy a house here. And therefore, approximately 82% of households here in California cannot afford to buy a median price home here, which of course is a huge issue. They also noted due to high inflation levels we have right now, this is going to keep interest rates elevated and will likely suppress home buying demand and will contribute to a weaker housing market in 2023. And according to the association's president, who's Otto Katrina, he had this to say: as home sellers adjust their expectations, well-priced houses are still selling quickly. I would say that this is true in virtually any market. If you price your house low, for example, chances are you're probably going to sell your house very quickly. Let's have a look at the averages across the state for the most recent data we have from them. This is actually from August. I'll have the update for you guys tomorrow for September, by the way. So the median days in the market, this is the time period when a home seller lists their home for sale to only ultimately accept an offer, and then eventually the house closes escrow or the sale is finalized. The median days in the market is 19 days. Look at this though, because that's a 111% increase compared to the same time period 1 year ago. So from August 2021 to August 2022, days in the market increased by over 100%. Also, the unsold inventory index is at 2.9 months, an increase of almost 53% on a year-over-year basis. So while it could be true that homes that are priced correctly or priced well could be selling very quickly, on a statewide average though, that's not really the case given the fact that the days on the market increased greatly, and also the unsold inventory index also increased greatly from August of 2021. Now here's something I do agree with him regarding though, because he talks about home buyers. There's more houses for sale, there's less competition, and fewer houses are selling above the seller's asking price. And that all points to a more favorable housing market for home buyers right now, especially those who sat out or were overbid over the past couple of years. They're also forecasting for a dip in the US GDP down 0.5% next year in 2023. Also, they say a stubbornly high inflation and growing economic concerns will keep the average 30-year fixed rate mortgage to be 6.6% in 2023, up from 5.2% that's projected in 2022. And by the way, at the time of this video, according to the Mortgage News Daily, as of today, which is the 17th, the average 30-year fix is 7.12% for people with exceptional credit. 1 year ago, rates were 3.16%. So in other words, rates have increased almost 4 percentage points or 396 basis points compared to 1 year ago. Also, according to Investopedia.com, the average rate is 7.25%. And here's what the California Association of Realtors Vice President and Chief Economist Jordan Levine, here's what he had to say. As the housing market continues to cool, the U.S. economy will moderate further and is expected to slip into a mild recession in the first half of next year. High inflationary pressures will keep mortgage rates elevated, which will reduce buying power, but will also depress housing affordability for prospective buyers in the upcoming year. As such, housing demand and home prices will soften throughout 2023, and more on that here in just a little bit. And speaking of a lack of housing affordability in California, take a look at this, because for the second quarter in California, California's housing affordability slid to its lowest levels in nearly 15 years. As such, only 16% of California households could afford to purchase the $883,000 median price home here in the state in the second quarter of this year. That's down from 24% in the first quarter of this year, and also down from 23% from 1 year ago. I mean, isn't that insane? Only 16% of people who live in California can buy a median price home in the state here. And this is down greatly compared to last quarter when the percentage was actually 24%. And check this out, because this is absolutely insane here as well. A minimum annual income of $199,000 per year was needed to make monthly payments of $4,980, including principal, interest, and taxes, on a 30-year fixed rate mortgage at 5.39%. So let's take a step back here, because last quarter, the second quarter, you needed $199,000 to buy a median price home here in California, but that was based on rates at 5.39%. But this is going to get a lot worse in the third quarter, given the fact that rates right now are above 7%. And check this out, because home prices in California were the most affordable in the first quarter of 2012. In other words, that was approximately 10 years ago, or actually more than 10 years ago, when housing affordability reached its peak. And at that time, approximately 56% of California's households could afford to buy a house here. And now again, it's only 16%, which of course is a huge, huge issue. And for the state as a whole, Lassen County was the most affordable county in California at 54%. Mono, Santa Barbara, San Luis Obispo, and Orange County were the least affordable counties in California. Real quick, I want to share some trends regarding how each of the counties fared, because there's some very big differences here and some pretty eye-opening stats. And then I'm going to get back to their housing market forecast here. And again, only 16% in the second quarter of this year can afford to buy a house here in California. That's 16%. 1 year ago, it was 23%. Look at this though. The median qualifying income is $199,200. Again, that's your average monthly mortgage payment when you include taxes and insurance. And that would be a $4,980 per month housing payment. By each of the major regions here, Los Angeles was the least affordable at 17%. That was followed by San Francisco Bay Area at 18%. Look at this though. The median qualifying income to buy a home in the San Francisco Bay Area was $337,000. It was absolutely insane. The national average is $93,200, and that's a 38% affordability index here. And that would give you a housing payment of $2,330 per month versus in the Bay Area, $8,430 per month. And check these figures out for the San Francisco Bay Area. In Alameda County, which is just east of San Francisco, the median sold price is $1.5 million. You need an income of $338,000 per year to buy a median price home there. But it gets worse, because look at Marin, just under $2 million for the median sold price there. You need an annual income of $435,000 to buy a median price home there. Look at San Francisco, $450,000. San Mateo, $512,000 to buy a $2.3 million median price home there. And look at your housing payment. If you're putting down 20% down, based on the current 5.3% rate, 5.39% rate, your housing payment would be $12,800 per month. But again, rates right now are over 7% right now and not 5.39%. So in other words, these numbers here are going to get a lot worse in the months to come. Also, the median sold price in Santa Clara, $1.9 million. You also need an income of $428,000. Other areas worth noting here, the index in Orange County is only 12%. You need an income of $293,000. In San Diego, the affordability index is 14%, meaning only 14% of California's households can afford to buy a median price home there. You need an income of $218,000. The qualifying income in Ventura is $211,000, and also in Santa Cruz, $304,000 per year. In Sacramento, the index is at 27%, and you need an income of $128,000 per year. And by the way, the California Association of Realtors is going to release a third quarter housing affordability on November 10th. So make sure you're subscribed to this channel, and I'll definitely make a video regarding that in a timely manner once it's released. And going back to the California Association of Realtors housing market forecast for 2023, have a look at this. So for single family houses for resale, these are existing home sales, and these are, by the way, are in thousands of units here. Their forecast for 2023 is going to be 333,000 existing single family home sales. That's a decrease by 7.2% from 2022. And by the way, their projected home sales this year for 2022 is going to be 359,200. And by the way, going back to 2016, we haven't had levels this low. So in other words, the forecast or the projected forecast for 2022 is going to be at least a 6-year low. In other words, their projection for this year for home sales at 359,000 hasn't been this low since before 2016. And again, they're calling for home sales to decrease by 19.2% this year. And check this out because this is pretty eye-opening here. The median sold price in 2023, their forecast is calling for $758,600. That's their average median sold price in 2023 is what they're forecasting here. That would be a decrease by 8.8% from 2022. Therefore, the California Association of Realtors is forecasting for the median sold price in California to decrease by $73,000 next year. And check this out, because if you look at their forecast at $758,600, again, it would be their median sold price in 2023. That's what they're forecasting here. Again, down by 8.8% from 2022. Look at this though. 2021, the median sold price was $786,700. Look at their forecast, calling for that to be below 2021's levels. In fact, that's down by 3.6%. So, home prices from 2021 to 2023, they're calling for that to decrease by 3.6%. This is pretty astonishing given the fact that home prices increased by over 19% in 2021 and also projected to increase by 5.7% this year. So some drastic changes in our housing market here in California. Now here's something you guys should be aware of though, because even though they're calling for a dip in home prices next year, if you account for that, look at 2019, because in 2019, the median sold price was $592,000. So if you compare 2019 to their forecasted median sold price, home prices are still up by 28%. Here's also their housing affordability index over the last several years here, because in 2022, they're calling for that to be 19% for the entire year, the average for 2022. But the average in 2023 is only going to be 18%. And this, of course, is because of high home prices, but more importantly, the giant increase in average 30-year fixed rate mortgages. So next year, they're calling for rates to be 6.6% to average for the entire year. Now, this is vastly different compared to 2020 and 2021, when the average rate was around 3%. Therefore, this giant increase in rates and this lack of housing affordability is really pulling the brakes on housing demand right now. And you actually can see that when looking at the latest trends on altosresearch.com. That's altosresearch.com. The share of price reductions right now in California is at 42% right now. In other words, this is approximately double the share we had from middle of May of this year. So on May 13th, the share was about 20%. Now it's 42%. Going back 1 year, the share of price reductions in California was 23%. 2020, 21%, and pre-COVID back in 2019, approximately 35%. So the share of price drops right now in California is at least a 3-year high. This is actually on par with the national average as well, because the national average right now, according to Altos, is also 42%. And lastly, one more thing I want to mention with you guys is that Redfin, out of all the metros they track in the US, they're reporting as of the most recent report, which was actually published last week, They're reporting that there's only 3 metros in the US where they're seeing a decrease on a year-over-year basis for the median sold price. And 2 of those are actually in California. And one of those metros is in San Francisco. Right now, the median sold price is $1.504 million. That's a decrease of 1% on a year-over-year basis. And 1 year ago, the median sold price was up by 5% on a year-over-year basis. The other metro in California, we're seeing a decrease on a yearly basis here, is actually in Oakland. Oakland is just east of San Francisco, down by 3% compared to the same time period in 2021. This is vastly different compared to the spring months because during the spring, home prices were up by double digits. This is also true in San Francisco because in San Francisco, around April and May of this year, home prices were up about 10% on average. So it's absolutely remarkable to see the changes here we're seeing in California, some eye-opening trends we're seeing. So hope you guys got a lot of value of today's video. And of course, if you guys did, please hit the like button. I really appreciate that. Hope you guys have an awesome day and look forward to seeing you on the next video.